Well, it's that taxing time of the week again, the time we look forward to immensely. Blake Christian from Holthouse Carlin Van Trigt talking about tax. What are the tax issues small business owners should be aware of to ensure the optimal tax structure?
Well, anybody going into business hopes to have profits, so you want to look at what the taxes you're going to pay when you are profitable. You may have some losses when you start off, but the marginal tax rate of what you're going to pay when you're up and mature is what should dictate how you set up your business and things. And different legal entities have different tax rates.
We spoke about entrepreneurs and taxation last time, but what about small business in general? Is the US tax code small business friendly? And if it is, will it be if Joe Biden gets in?
Well, the 2017 Tax Act that came in under the Trump administration became much more business friendly to small businesses as well as large international. Small businesses in the U.S. are typically limited liability, set up as limited liability companies, and then you can tax those as either a partnership or an S corp. Those are the two in that order. That's the highest probability of how they're set up. So and the benefit of that is the income flows out to the individual owner, and that individual pays tax. Whereas in a C corp, which is kind of the Googles of the world, IBM, et cetera, those types of entities get taxed first at the entity level, and then when they pay out distributions or other amounts, those are taxed again at the individual level. So from a tax efficiency standpoint, most small businesses are either LLC partnerships or S corps.
What about if Biden gets in? Will this change?
Yes, he's already said that. So one of the things in a LLC tax as a partnership or an S corp, only 80% of the income is taxed. So rather than paying a 37% maximum tax rate, most people pay at about 29%. It's 80% of that 37%. Certain, high, you can have somebody with a small business that's making $1 million, $2 million, and it phases out. But for the most part, that 20% qualified business deduction that's allowed under the Trump administration would be removed under a Biden administration. He may leave it for some limited people, but for the most part, it's gone.
How does a small business ensure it pays a minimal amount of tax? And that's, I suppose, part of running a good business is to minimize your taxation. So how does a small business ensure this?
They hire me.
Superman, the superhero. But say, for example, if you weren't there, how would they do it?
No, they would hire a good CPA. Mm-hmm. And you bring up a great point, Mike, that if you look at it and you said, hey, would you like to pay 40% more for an item, an expense item, rent, supplies, et cetera, people are going to scream at you. How silly is that? But if without proper planning, a combined federal and state rate, you're easily paying 40% more than you need to. So you should know all the tax breaks that you can get as a small business.
What structures do most small businesses choose?
Again, for the most part, about 90% of our clients are either LLC partnerships or S corps. And what's nice about the LLC format is from year to year, with some limitations, you can switch. You can go from being an LLC to an S corp or to a C corp, et cetera, without having to liquidate and reform the business. So it's a very, very flexible structure in the U.S. The LLC platform. So and then the rest of them, You can also have a co-op. You can operate as a trust. You can operate as a C corp. And now we do have some of our clients that have, various operations. Sometimes we'll stick a C corp into the mix because that C corp only gets taxed at a 21% rate rather than and that's a flat rate versus the maximum rate for an individual at 37%. So a C corp does have its place, but as I mentioned earlier, when that income is distributed out, you pay another layer of tax. Usually it's at a 15% capital gain rate, just because of the way the tax law is structured. But still, you do have to factor in that double taxation with the C corp.
How does a business determine what type of structure is the right one for them?
Well, it does. It actually changes over time, and so that's why the CPA needs to ask a lot of questions. So what's a fairly common fact pattern is you come to me, I start asking you, what is your, what's your startup losses? How long will it take you to become profitable? And so that's where you say, well, I'm going to, for the first year, I'm going to have losses because I just am not going to have enough revenue to cover my rent and my, employee wages and things. But then I'm projecting profits. So that's where we'd normally set you up again as an LLC or a partnership. Those startup losses would flow out to you, be reported on your personal return. You could claim those losses, and then when you become profitable, we might convert you to a C corporation, depending on the type of business that you are. And now, after we've used up those startup losses, we only pay tax at a 21% rate. But the other question I would ask you is, in that situation, if you were going to build up capital in the C corp, that makes a lot of sense. But if you told me, oh no, I'm going to be stripping out all the profits every year, then I would probably tell you to be an S corp, because then you wouldn't have the double taxation. You would have already paid tax on the core business, and you can pull all that income out without a second layer of tax.
Are there other considerations than tax?
Yeah, there's legal issues, and then there's state issues. For example, in California, most states don't impose a state tax on the S corp earnings. California imposes a tax of 1.5% on the net income, and then they also have a gross receipts tax. And so we try and avoid, actually the gross receipts tax is on the LLC. So sometimes we'll set up a general partnership instead of an LLC, and then you cap out your annual fee at $800 rather than it being up to about $12,000.
Do all businesses pay both state and federal tax no matter where they are?
That's can be a little bit of a tricky question. There's a concept called business nexus, and most states will tax you if you either have employees, sometimes independent contractors that are physically located in that state, even though you may not have a business location there, or if you had, say, a warehouse and had inventory there, that would cause you to have Nexus in most states, or if you register in that state to access, say, the court system and things. Now, in the last few years, and this is a very complex and contentious area, is because of all of the web-based sales and things, both sales tax and income tax are being much more aggressively pursued by the states. You can have what's called economic nexus. So generally, if you have, each state has a little bit different criteria, but as a general rule, if you have more than than 500,000 in gross sales to a state that you're not normally operating in, they'll do two things. They'll impose sales tax on your customers in those states. It used to be you would dodge sales tax, which made it very attractive. And then oftentimes that will also trigger the income tax. But again, it gets very, very fact specific, and each state's a little bit different. And that's why we have a state and local tax practice with about 25 people in it that's all they do, because it's a very complex area.
What should people do, though, if they want to know whether they have the right business structure? I would imagine contact a very good CPA or just a CPA.
Right, and I would, it's one of those things where clients, business people, it's just like going to the doctor. You can't just go in there and not tell them anything and say, how am I doing? They can analyze you to a certain degree, but you got to tell them, what issues you have. So, you should be asking, small business owners should be asking their advisors, am I set up properly? They should be asking their attorney as well as their CPA every year. Initiate that discussion and say, hey, things have changed. I've opened, another location. Am I still structured properly? I've doubled my sales. Should I do anything differently? And all those little tweaks in your fact pattern can, sometimes trigger you to change your legal structure a bit.
It's tentative times with the federal election or the presidential election next week, next Tuesday. How are your clients at the moment? Are they a little nervy or just wait and see? And yourself, how do you feel that? What do you think might happen on November the 3rd?
Well, we'll start there. So I know all the polls are indicating a Biden win, so I'm going to stick my neck out. But we have the Electoral College over here, which is a very complex process, and the popular vote doesn't determine the presidency. The Electoral College does, and it's been around for 240 years. Was not complained about at all until the 2016 election. But a lot of the reports that I've been looking at, which the press doesn't, is that it's very possible for Trump to win with the Electoral College, and it may not be a very close race as the press is talking about. So I'm not going to be surprised to see it be very similar to the 2016 election and him lose the popular vote, but dominate on the Electoral College. My clients, they're surprisingly quiet right at the moment with respect to, I don't have any clients panicking. What should I do before the election? What should I do? But a lot of them are waiting and will be caught. They told me, I'll be calling you after the election. So if Biden gets in, from a CPA standpoint, it's going to be a gold mine, because we're going to have to redo everybody's tax planning. People are going to do a heck of a lot of year-end planning this year. So if I look at it on an economic basis, I should be rooting for Biden. But I'll forego the extra fees and hope that we have the status quo.
Blake Christian from Holthouse Carlin Van Trigt, or HCVT.com. Thank you very much.
Great to see you.